Reserve Bank of Australia could be staring at zero lower bound. That's the topic of discussion for now. To start with, last week, Reserve Bank of Australia kept rates unchanged, and the policy statement was neutral. It didn't offer anything new. The next day, however, their governor, while delivering a speech, I don't know exactly where, at some Australian event maybe, he basically he put rate cuts back on table. Now for last almost 1.5 years, all we have been hearing from RBA is that uh, the next move in rates will most likely be on the higher side. So they had a tightening bias, and now they have shifted to a neutral stance. Like the statement was RBA Governor Lowe's comments where the probability of rate cut is as good as the probability of a rate hike. So basically he has left the doors wide open for a rate hike and rate cut depending on how data unfolds. But if you take into consideration the background, that is the fact that they had a tightening bias, the shift to neutral is as good as dovish turn. Mind you, markets were already pricing in the possibility of 25 basis point rate cut by the year end. So it's to some extent it's not surprising. What surprises me is that I read that couple of banks are still expecting RBA to hike rates. All they have done is they have pushed out their rate hike bets. Some of them are expecting the central bank, Aussie central bank, to hike rates next year, maybe in the second quarter or something like that. I believe the central bank is most likely staring at zero lower bound. What do you mean by zero lower bound? Zero lower bound is your rates are stuck at extremely low levels, near zero levels. Some of the central banks have interest rates in the negative territory. For example, ECB's deposit rate is, I guess, minus 0.4%, and it's way lower, like minus 0.75% in Switzerland. In Bank of BOJ has deposit rate at interest rate at minus 0.1%. So it's kind of crazy. I find that crazy. It's like interest rate negative, having a negative interest rate. It's like I'm lending money to someone and I'm also paying him money instead of receiving interest rate. So it's kind of crazy. Let's not go there right now. The focus right now is RBA, and why I feel it's staring at zero lower bound is like interest rates currently are at 1.5%. So what I'm essentially forecasting here is that slow and steady, the central bank would take rates all the way down to uh, zero, and then they might have to push the QE button. The first thing that you need to know is why the 2008 crash happened. Most people put the blame on subprime crisis. Indeed, was a subprime crisis, but it was not the reason. The reason was global imbalance. Like, as I understand it, China has been running a export-driven economy, and US back then was a largest consumer. And basically, these two are faulty models in a sense that the population of United States is not big enough to run a sustainable consumption-driven economy. So it was essentially a leverage-driven consumption. On the other hand, China has huge population, and it has been practicing financial repression for years now, and through that, they're running a forced export-driven economy. So these two major economies, world's largest economy, US, and world's second largest economy, they were operating on a let's say, I would say that their growth models were faulty, and so some or the other reason, it was bound to happen. The crash was bound to happen. In US, it happened. Subprime crisis. It destroyed consumers' balance sheets, and in a way, US is now, crash is always a blessing in disguise, in a sense that it forces adjustment. There is a quick forced adjustment. So US is practically, it's kind of ready to become an export-driven economy. The other side of the story, China, it's it's still, it's kind of making a transition in a slow, controlled manner. So I like to call it as a controlled explosion, sort of. And that is the reason why there is huge aggregate demand deficiency in the global economy. And when these two economies are operating, given that these two economies were operating on a faulty base, and so what it indirectly means is that all the other nations, some or the other way, they are messed up as well. For example, Australia, it has practically not entered recession for like two and a half decades or something like that. And the biggest reason being it's heavily exposed to China, and just China has just its growth rate post 2008 crisis reached 11% because they stimulated their economy. Then again in 2016, in early 2016, when stock market started collapsing, they again stimulated. And the net result being Australia never entered recession because its maximum exports are of commodities and iron ore, copper, things like that. And China is one of the biggest importers. I guess the biggest importer of the commodities. So Australia never entered recession, and the reason being, every time there was stress in the global economy or in the Chinese economy, Chinese just stimulated, fiscally stimulated, or cut rates, etc. But off late, maybe at the turn of the year last year, China has made it clear since then that they are not going to spend the way they did. They are not going to stimulate the way they did before. Then the word is flood-like stimulus. So there's not going to be a flood-like stimulus anymore. And suddenly, RBA takes a U-turn. It ditches its tightening stance, and now it's open to cutting rates. So do you get the connection here? The connection is very simple. Till now, RBA didn't have to really flex its muscles because obviously China was doing that. But now China is no longer ready to give a flood-like stimulus, and so the burden is now on RBA, and I feel that's the reason the central bank has just ditched their tightening bias, ditched its tightening bias, and I feel the rates are going down. If you read a book on global imbalance written by Michael Pettis, is a very well-known, respected specialist on China, and he has explained it very nicely in his book that China's GDP can go as low as 2% or 3%, or even worse maybe. The adjustment is not going to be that smooth, and which means the pain period is going to be a long one. It's not over yet. I read a few days back, JP Morgan said in their client note they recommended rotating money out of gold and into China-sensitive stocks listed in US. That's somewhat surprising to me because they are expecting some good news from Chinese front. But I don't know, I don't really think it's going to be a big bang stimulus. One of the major reasons for that, why I believe that is, global markets have developed a sort of nauseated feeling for stimulus. There has been so much stimulus, so much money floating around that I think the marginal efficiency of any new stimulus announcement is close to zero. It's not going to yield any results, and it will only create side effects. So I think Chinese have understood that, and they are no longer in mood to give flood-like stimulus. And so now Australia is exposed big time. So they just imagine the nation hasn't witnessed recession for like 2 decades or more. And I would have bought that, I would have considered that a real achievement if Australia was a high population consumption driven economy like India. So the reason being, when you have a very young population and a very high population, your economy is on a sort of autopilot. It's like you don't, for example, in case of India, Indian economy is going to grow by 3% or 4% any case. If there is a recession, obviously if there's a 2008 style crash where the global trade just comes to a screeching halt and every economy contracts, obviously Indian economy is going to feel the heat as well, and it will contract for a couple of quarters. But that's it. Once that immediately Indian economy would recover irrespective of the stimulus. The simple reason being, we have such a huge young population. We are on an autopilot mode. Indian economy is going to expand by 3% or so anyhow. So irrespective of whether the government is good or bad, or they're delivering good reforms or not. In Australia's case, I'm afraid I cannot say the same thing. They are an export dependent economy, and an export dependent economy, as the word says, dependent. You're indirectly dependent on what the other country does, or you're at the mercy of other country. And in this case, Australia's case, it's dependent on China. And as I said, the Chinese GDP can go as low as 2 or 3%. The adjustment is not over yet. The pain period is going to be a big one. The global markets are growing. You're feeling nauseated. Too much stimulus has been, too much money has been injected by various central banks, governments, etc. And marginal efficiency of any new stimulus measure is as good as zero or even negative, I would say. So, the only thing now left is Australia's central bank would have to, flex its muscles, and the first thing they would have to do is cut rates. I think over the next 2 or 2.5 years, it's going to hit zero lower bound, and then maybe quantitative easing or somewhat. See, it's pretty simple. As I was explaining a few minutes ago, US was running a 40 consumption-driven growth model, and China investment-driven growth model. And first US crashed, then Europe felt the heat of debt crisis. China and emerging economies haven't really had that, haven't really suffered till now. Even I would say Australia technically didn't enter recession simply because China just kept on stimulating the economy, but that's gone now. And so the next logical step is, rates have hit zero in US and they have been lifted up again. If I'm not wrong, the federal, FOMC interest rates stood somewhere above 4% before the 2008 crash, and now they're back to 2% and more. So I would say that they have undone 50% of what they did on the interest rate front. That's the only part of the that's the only advanced nation which has room to initiate stimulus again, and it's the new again. The rate cuts would work because they have created that much room. Europe is in a negative territory, and any new stimulus is not going to do the job. Bank of Japan, I don't have to say anything. It's been stuck at zero lower bound since ages. And so the next logical step is obviously the nations who have been shielded in a way by Chinese stimulus, and it's Australia, and New Zealand is going to feel the heat, and eventually China itself would have to, cut rates. I think China wouldn't put in flood-like stimulus. It would have an indirect stimulus with the help of weaker yuan. So, emerging economies, especially in India, in Asia, should get ready for a significant depreciation in their currencies. So, yuan would fall. It would drag down Indian rupee and other currencies as well because it's a regional anchor. So, as I said, the next big event is this next logical sequence, I would say, is now zero lower bound in Australia, zero lower bound in New Zealand, maybe QE in Australia. So the ideal trade would be to buy Australian stocks or buy gold in Australian dollar terms, short their bonds, initiate curve steepeners. It's like betting that the curve would steepen in a way, I guess, and things like that. These are the trades you can initiate when it comes to Australia. But the message is quite clear. It's in my opinion, it's heading towards, it's staring at zero lower bound, and there's no way out now. As I said, it would most likely happen over a period of 2 years or so. And they would be down to 0.25 or 0.50. There's, I don't think even they won't require even 2 years. I think it could happen in just maybe even 1 year, because right now they are at 1.5%. So just 100 basis points is like every meeting or every other meeting, just 1 year, like 25 basis point cut every quarter, and that would bring them down all the way to 0.5%, 0.25%. So that's my take on RBA. As I said, I'm least surprised that they have turned they have turned neutral, and they would certainly uh, go on to cut rates unless and until, the only risk to this view is that China somehow does uh, again initiates a flood-like stimulus. In that case, again, Australia would be shielded. And but here is the deal. The longer Australia remains shielded, the bigger the pain would be eventually. So it's good now that reality is biting. Reality bites hard, and that's what's going to happen. So that's my take on RBA. I hope you enjoyed. Thank you.